Stop using the dividend payout ratio when you analyze dividend stocks. There is a way better metric to substitute it that does the same job but gives you a clearer picture of how sustainable the dividend is. Hi, my name is Ognian and welcome to the Dividend Method channel, where I explore investing, personal finance, and how to achieve the financial freedom we all desire. In this video, I will talk about one of the most common metrics people use to evaluate dividend stocks and why they are wrong to focus on it. And that is the dividend payout ratio. I assume a lot of you might know what that is already, but let's just give a brief definition for the new investors here. The dividend payout ratio is a metric that is commonly used to evaluate how sustainable the dividend of a company is. It is calculated by dividing the dividend per share by the earnings, or you can also think of it as the company's profit per share. If the company pays more dividends than its profit, then obviously this is a red flag and something is going wrong. It might be financing it with debt or in any other undesirable ways. The goal is that as dividend investors, we want to identify this red flag before we invest in the company so that we don't suffer an inevitable dividend cut down the road. Now, when I said in the beginning that you should stop using this metric, I did not mean to stop evaluating whether a company's dividend is sustainable. Obviously, you want to do that. As a person who teaches dividend investing, the last thing I would recommend anyone to do is not check whether the dividend can be sustained or not. What I actually mean is that, in my opinion, while this metric gives you a good idea of how safe the dividend is, it doesn't give you the clearest picture possible. I will first share with you what the issues with this metric are, and then I will tell you what metrics to use instead. I'm actually amazed this is not a common advice in the investing community, but it is what it is. So, what are the flaws of the standard dividend payout ratio? Well, to understand that, you need to understand that companies use standardized accounting practices which determine the reports which they will put out and the taxes they pay. So, for example, a company might have a factory that is super profitable, but at the same time, they are using certain accounting tactics that will lower their taxes, like subtracting millions and millions of dollars of the value of the factory for what is known as depreciation and amortization, which is basically them saying to the taxman, hey, this factory is making us $10 million per year, but it is actually getting old and costing us $11 million to keep it functioning, even though the company might only be spending $500,000 per year to maintain it. Now, for you accountants out there, I know this is a vast oversimplification, but I'm trying to not turn this video into an accounting lesson which puts people to sleep. Another example is a company that paid $1 billion for acquisition of another company 5 years ago, but now that part of the business is bankrupt, and so they are deducting that $1 billion from their earnings in order to pay less taxes. It is a smart move, but at the same time confusing for you as an investor, because the $1 billion have already been lost 5 years ago. It is not being lost now. However, that $1 billion might be enough for the dividend payout ratio to shoot up to 130%, making you think the dividend is unsustainable, when in fact it is perfectly safe. However, if you only use the standard dividend payout ratio, you will pass this opportunity. On the contrary, you might also be fooled into investing in a company which dividend looks safe according to the normal payout ratio, but it actually isn't. The point is, when you evaluate the dividend of the company, the best strategy is to use the actual money that it has available for distribution to you. Or, to put it another way, the actual cash. This is why we need to use something almost no one in the investing space talks about, but which in my opinion is one of the most important metrics for all investors, especially dividend investors: the levered free cash flow. For that purpose, we need to go to the cash flow statement and search for the levered free cash flow. Now, what is levered free cash flow? Levered free cash flow is simply what cash is left in the business after it has paid everything you can think of. Why levered? Because you also have unlevered free cash flow, which is the money left in the business but before it pays its financial obligations. Levered free cash flow is what is left in the business to distribute money to shareholders, invest in new areas, acquire other businesses, or pay down their debt in order to lower it. So here is a fifth grade example. Imagine you own a bakery. You make $100 in sales today. The cost for the materials is $40, whatever bakery stuff is made of. Bills are $10. The salaries are $10. Are you keeping up? You also have to pay $10 interest on your debt you took to start the bakery. So what is left for your company? $100 from sales minus $40 cost of products minus 3 times $10, that's for bills, salaries, and interest on debt, equals $30. $30 is your levered free cash flow. So what I personally use and what I advise the people in the dividend method program to use is not the standard dividend payout ratio, but the dividend as a percentage of the levered free cash flow. Going back to the bakery example, you decide you will pay $15 dividend for your personal expenses and life and leave $15 to save to buy a new oven in the future. So the dividend you just pay yourself is 50% of the levered free cash flow, because 15 is half or 50% of 30. When you actually think about it, it's not so complicated, but I am amazed that almost no one uses this ratio. It is the clearest way to see how sustainable the dividend is. No accounting tricks, no depreciation of buildings that actually go up in value, subtracting losses that have been paid for years ago, etc., etc. So, how do you calculate that ratio? Unfortunately, unlike the normal dividend payout ratio, it isn't readily available. However, the calculation is pretty simple. I will take the Coca-Cola company's cash flow statement to use as an example. Why? I have no idea. But I always default to using that company both here in YouTube and inside the dividend method program for my students. Perhaps because everyone knows who they are. I don't know. But anyway, here's what you do. Again, you go to the cash flow statement. Then you scroll down until you locate the levered free cash flow and the dividends paid figures. Then you simply divide the common and preferred dividends paid by the levered free cash flow. In this case, we get a 63% ratio for the last 12 months. That way, you can get a way better picture of the dividend sustainability. Now, a word of caution. This type of calculation does not apply to all types of companies, just like the normal dividend payout ratio doesn't. For example, if you are evaluating a real estate investment trust dividend safety, you will want to use a metric that is called AFFO, but this is a topic for another video. Alright, if you learned something new today, please press the like button, or otherwise you're going to make me very sad. And also subscribe by clicking the notification bell and enabling the notifications for more videos related to investing, personal finance, and achieving financial freedom. That way, you will be able to get my future videos without relying on the YouTube algorithm to randomly show them somewhere to you. Also, if you would like to find out which top 4 stocks and ETFs I like the most for the current environment we are in, go to the description and get my free report, which will always be up to date regardless of when you watch the video. Take care and see you soon.